Good afternoon. Welcome to Green Bicep. This is the summer update. This is week 31, August of 2023. So far, the market has been doing quite well, up 17% year to date, but it has been a choppy market with just a few sectors leading essentially. Then we started to have some small caps push up, industrials, and most recently the tech has turned over, and there was a strong sell-off on Apple on Friday. Amazon did well. PayPal got hammered. Uber got hammered. So there's definitely a rotation going on currently within the financial markets specific to stocks. GDP is estimated to be at 1.3% this year by Morgan Stanley. Sarah Wolf said that, and I presume that's nominal GDP, which is extremely low. Most forecasts are currently well above that. She said that this morning on Bloomberg. The 10-year real rate is at 1.4. And so when you take rates greater, when rates are greater than growth, it implies that a rate cut is likely. You have the cost of capital greater than growth. That's not a good sign for the economy. So this would imply a yield curve adjustment. And typically post a yield curve adjustment, the stock market corrects and typically will go down 20 to 40%. So market is currently, though, the market is already in correction mode. Leaders are falling, but there is relative strength in certain areas such as oil. So oil will likely do quite well in the next, we'll get into that specifically on the rig count, but oil is definitely, there will be a constraint or lack of supply in the next several years. Non-farm payroll. So that came out on Friday. It dropped to 3.5%. They're always playing with the numbers, so I don't put a lot of weight into it. Obviously, if it jumps dramatically one way or other, you want to notice. Underemployment is at 6.9%. That means those people are just not participating overall, and which labor participation is flat. And so this has been flat for 3 months, and that just looks strange to me. From the just the numbers look odd, and we'll get into that more on why the labor numbers are not consistent. Bitcoin is at 29,000, gold's at around 1,900, and most recently BlackRock applied for a Bitcoin ETF, so that is good for Bitcoin in general. It means that essentially the US is adopting Bitcoin because BlackRock manages almost $10 trillion rounding up, and so they're the largest money manager in the US, as far as I know, or at least they have assets. And then Fidelity as well is large too, and they manage in the trillions. And both of them have applied for Bitcoin ETFs most recently. I am saying there's a sell on Apple now, and we'll get into that more. The all-time high was 198. It's now at 181. So Apple needs a lot of growth. So to sustain its current price and go up higher, they're going to have to buy back a lot of shares and find new areas of growth momentum. Overall, consumer lending continues to decrease while convexity is mute, as elasticity is high. So that ultimately means that the rate of change on prices isn't changing a lot. But if it did, you would have the lending will immediately impact the economy. So that's why I said elasticity is high. It will change with it. It's similar to that of gamma. So housing permits are still very weak, down 20 to say 30% on average. Single family starts came in negative 2.7. So housing is definitely just being controlled. I would call it controlled. And because of that, it's allowing for prices to be stable. So the home builders are essentially controlling the housing market by keeping inventory at a minimum. So there aren't a lot of spec homes now across the USA. And affordability is an issue. So the plan is for mortgage lenders and such. They're gonna merge the type of mortgages together. So if you want to sell your house and you have a rate of 4%, and then someone else comes in and the current rate on the market is 8, they'll give you a average of the two. And that's something that's being in process, is likely to come through. So that will help sustain prices. Next are the markets. So the market in general, this is the S&P 500, the Dow, New York Stock Exchange, NASDAQ, all the markets. And most recently, they all started to turn over. We have 1, 2, 3, 4, 5. So it's only 6 days approximately since the highs. For the NASDAQ, it's more than that. And then we have the oscillators going negative. And so the question is, are we in a situation where the oscillators just dip negative and go back up like this situation here? So there was a quick correction, or is it going to be a little deeper? Based upon what I'm seeing by the price action as well as the volume, this correction is going to be much deeper. Looking at Apple, massive volume to the downside. So there's going to be a correction. There's a rotation going on. Disney was up on Friday. And that's more of a trade for people, like they're trading it. And so there's just a lot of trading going on. So just a lot of volatility that people trying to take advantage of. So the area, though, where you will see strength is in energy, specific to certain areas in oil. So what does this imply? This implies the trend is down, price is going down. So normally you want to buy the dip, right? You want to buy when prices are down, but you don't want to buy too early. So let's wait for this to turn around, at least have 6 days of uptrend, since we have about 6 or so of downtrend or more, and just so you don't get clipped. Next is Apple. We're getting to the Apple. So Apple has an economic book value of $66 per share per new constructs. Based upon this, their metrics, their free cash flow yield is in the 60th percentile. Price to economic book value is 40th percentile. And they're one area they extremely excel in is return on invested capital. That's where you take your money, your profits, reinvest that, and that rate of return on that reinvestment is return on invested capital. So they're excellent in reinvesting their capital. But beside that, you can see there are structural issues with them. Apple's cash per share is volatile from 103 to 269. I think the main point here is, like, I'm not an expert on Apple. I'm just looking at the data high level, just point out obvious things. But you can see Apple drop from 1.9 to 1.6 to 1.55 for cash per share. So you could say there's 3 data points. That's a trend. That means their cash per share is trending down quite dramatically, percentage wise. I mean, that's like, you would think their stock would get destroyed, actually, dropping from 190 to 160 to 155. Next on Apple, the price to book is 47. People usually want to buy companies with a price to book, ideally like at 1 or under 1 during a recession, and then obviously much higher and not in a recession. Their PE is currently at 30, and everybody's going to be like, oh, what about forward PE? The fact is their PE today is at 30, so it's a very expensive company. It could get a nice haircut. So Apple, the theme here is valuation, a $30 price to earnings ratio and a price to book ratio of 47. How could they maintain that? Keep those current ratios? They got to have growth, more revenue. Are they going to be able to achieve that growth? That's the question. So the catalyst is a sell on Apple. It was Apple earnings. They came out. The market hated it. Volume heavy, down. That's the catalyst. Price targets are 445, 440. 436, then 413. Obviously, if we hit 445, it hits it, chop around for a while, turn around, go up on volume, come down on lighter volume, and plays off of that normal, healthy market movement. Then Apple could go take out the new highs. However, if it hits 445, can't hold it, and starts to trend down on volume again, then you're going to see 436, then lower. It's pretty simple how it works. People just you got to be able to recognize the levels, and when you understand the supply zones and supply and demand zones, and so if it hits a new level, it should chop around and you should start to see healthy price action. Not unhealthy would be if you're starting to get rounding tops. That means likely to leg down. If you get the opposite, more of a V over and over, then you're likely to go up. And it gets more complex than that, but that's like the very basics, and it's usually quite obvious as well. Just people are so like brainwashed or into their theme of a company doing XYZ, they don't actually recognize what's happening in front of them. Everybody does it. So the catalyst for reversal, new drivers of revenue that would augment earnings, thus decrease PE or change in price with significant volume, more than average. Next, the sector. So what has been doing well? So most recently, it's been energy in the last 30 days, still with tech, communication services and tech in general, just rocking and rolling with the whole AI theme. So the AI theme has really been pushing prices up. So it's really been more of a price volume type. It's been more of a momentum trade, but there is real fundamentals to these companies too. At the same time, it's just when unknowns are unknown, then you're going to have more of these odd moves up or down. So you have the companies, so it says Palantir is how you pronounce it. They're doing quite well, DoD work, and they've run up a lot. We'll see if they baseline for a while or not. It just depends, on their growth and what they want to share. They have Snow. It's another one that's interoperable. It hosts data. It takes data and basically is able to map all that data. It's able to share it with other data sets as well as with clients' customers, and so allows data to be interoperable. Snow is a game changer from my perspective. So it's something worth watching the price of that company and understanding. And I've just begun to get into it. And I need to move fast because likely price will go up by the time I finish my research. So overall, this is where we're at. Utilities have been weak. I think an area to focus on may be in the area of like energy in different forms. Like NextEra is a company that has alternative energy, and because Elon Musk said something, and so I presume it's the truth in this case, where he said there's going to be a shortage of energy in 2 years. And then you're starting to see like brownouts and this and that. Most recently, I heard about in Texas, I believe it was, or their bill was like up quite substantially. So there's just a lot of supply and demand constraints currently with energy. So that's something to watch in the next 12 to 24 months. And maybe those companies are actually hitting in different sectors. But usually the worst performing area is where you want to be at some point. So energy, healthcare, and utilities year to date. So at some point, those will outperform. Next is the commitment of traders report. This is May. This just shows you the amount of liquidity in the financial markets or accessibility to liquidity. What that means is they could get money and buy stocks and sell them, but keep the market in a controlled range. So when you see all these going up, that's going up. The green's kind of going up. The red's holding steady. It's pretty healthy. The purple is just kind of going up. And then you looked at the net numbers too. That gives you reference too. So dealers are definitely have a lot of liquidity in May. Now, if you flipped it now, the dealers have dropped way down. The liquidity's dropped dramatically for the dealers. And then if you over here, it's dropped dramatically for the commercial. Actually, it's commercial here, then the dealers down here. The asset managers have gone up. So the asset managers are taking on more risk while the market makers are pulling their risk back. Typically, when this contraction starts to happen, you can see a contraction, the market will correct. So it's kind of playing out like in a book you're reading and you're like, wow, this is actually happening. And you can see even back in March of 2022, April, May, June, it really contracted. So we're actually starting to contract a lot, except for the asset managers. And so, yeah, they're going to get screwed. That's likely the case. Next, summation index. This is just looking into the internals, advance and decliners of the market, showing the strength. We went negative again. And it's likely this is going to play out. There's a lot of negative divergence. That means like the internals are weak of the market while the market's going up. So that means the market is like artificially being propped up in a certain way. And sometimes it's just because of lack of liquidity. So price points move quickly to supply and demand zones. So it's turned down. This is likely going to continue down for a protracted correction. Non-farm payrolls, they came in. The numbers were good overall from my perspective. I mean, the trend's up. The problem is when you take the 3-month average year over year, the trend is down. So we'll see how this adjusts itself in time. So seasonality wise, we're weaker than last year. Trend wise, the convexity of it. Yeah. So then we're talking jobs, employment, non-farm payrolls, and then now net job revisions. This shows how many revisions were done by the government. 45,000, 63,000, 19. So they're just the data. Like January was wonky. The numbers didn't make any sense, and the market rallied. So there was some cooking going on, and these are the revisions. So you got to take everything with a grain of salt. Getting into commodities, I put this in here just to record a historical standpoint of where raw input commodities are year over year. You could quickly see the inflation has dropped dramatically. Like you have uranium up, you have silver up, copper, gold, but steel, that's not good. If you're seeing steel down, even crude oil is still down 7% year over year. That's just not good sign for the economy. So we need to see improvements. Other commodities, orange juice, cocoa, sugar, all up a lot. Tea, potatoes, but on average, most raw input commodities are down 20%, 25%. But you're not going to see the retail costs drop that much because retailers want to keep their margin. So like Pepsi raises the price. It's not going to drop the price, even though it already laid off people and the economy recovers, inflation drops. They're not going to do that by any means. But the cost of capital went up. They raised interest rates. So obviously that's the new standard for the cost of capital, which means prices will have to stay higher. So that just proves that raising rates actually augments inflation, or sustains it at least. All right. Next, cattle up actually quite a bit. Eggs are up a little. So food is, there is some pressure on food still in the United States. CPI data is coming out next week. This is prior data set. It's interesting looking at this. You could see that on aggregate, inflation is down a lot. And this is at the retail level. So who's controlling the ultimate price? It's the stores, the service companies, and yeah, I mean all items 3%. So you can argue, you could make up your own basket. Okay, we're gonna have our basket. We're gonna have cereals in it. We're gonna have some electricity and some medical care, and you're going to say, yeah, we have a lot of inflation. So anyhow, so Michigan sentiment, this is another sentiment phone calls. Typically this follows the price of gasoline. I believe it does. That's just anecdotal, but it's actually up a lot. I don't know. I'm not sure if I believe the data. It just doesn't quite make sense because gasoline has really shot up. So people are obviously happy about other things, which is good. Michigan inflation expectations, same dealio, it's improved. So I think that's really where it goes hand in hand. The peeps of the United States believe that inflation is going to drop. It's not as bad as what it was. So this is slowly finding its way up. And commercial loans drive the economy. This has continued to trend downward. So that implies more contraction in GDP. This is the Restrict Act. It's worth reading about. 1 million or more Americans do anything together online, and then they could be shut down. I need to research that, but it's worth sparking commentary. This is old, so I'm going to update this. I'm going to probably pull my own data and just start doing it, but earnings are probably down, trending down, and I know claims jumped up and came down, but overall they're higher than where they were here. ISM is actually went down and started turning a little bit, kind of like everything now, just a little bit farther up. So there's not a huge change in this at this point. So it's like this protracted recession, or they're trying to cause a recession. And I think the word recession, I mean, you're going to have a recession maybe for different income brackets. If you're upper class, upper middle, lower, there's going to be recessions in certain areas depending where you live in the country. So I think you kind of have to look things as non-binary, not just black and white, but realize the housing market might be hot in Florida, but it suck in New Jersey. And so here we're looking at market moves higher when the Fed expands the balance sheet. And this is just historical data. I didn't update this chart on it, but the next one is updated. So you can see when the balance sheet drops, typically the market contracts. I mean, this is kind of rough math, but it's pretty solid stuff overall. And so if you go to the next one, you can see this is updated August 3rd. You can see the balance sheet is contracting still. Obviously, there's people, it's not just the Fed's balance sheet that's going to drive everything, but you want to watch it because that implies what their actions are and what they intend to do as well. So the rig count, this is for oil. So we can see that it just continues to drop. And now we're at 525. So basically, they're not opening up any new rigs to drill for oil. And that seems concerning to me, which is good for the price of oil if you want it up. Bad for the consumer, right? So this is the Bloomberg Commodity Spot Index. It's still hanging around just this major support level. I kind of tried breaking out, couldn't do it. So it needs to hold this. Otherwise, we're going to drop way back to the lows and you're going to see some serious deflation. And that is likely. I haven't ran around the countries and looked at all the PPI data, but they were heavily negative, and so deflation or drop in prices, however you want to say it, has been going on. So that's like the worry here. So sentiment, and so you can see that the sentiment has gotten a lot more bullish. Once it gets skewed too much to one side, that ultimately means the market's likely to reverse. So it's always the opposite with the financial markets. So being bullish 49%, 51, I don't know historically if that would be over bullish, but that would make me lean, okay, at a certain point you might want to look to be bearish. This is just a spread. It's still large between government bonds and corporate credit. This is dated, but it's still, we have a large spread, and that implies essentially weakness in the structure of those institutions. And growth slowing, inflation slowing. We're in quad 4. Quad 4 says typically tech doesn't do well in quad 4, but it's doing quite well, especially with the AI push. Yeah, the market in many ways the market wants to turn and run up, but the problem is there's just too, when the PEs of Apple or companies are it's just too they have to readjust, buy low, sell high, and so maybe the Disney of the world will have their run, and then so on and so forth. And that is it. So thank you for tuning in. Big picture, I see essentially we're correction mode. What would offset the correction mode is essentially the market just turning around and rallying right up through the top, acting like nothing happened with more volume. That means more money came in from the institutions and pushed the market up. That could happen. Saying that right now, everything looks to be heading down. So plan accordingly. The yield curve inverted still. looking at the data I looked at today, I spent quite a few hours reviewing. Not more optimistic than before at all. Yeah, so yeah, they're just everything's very fragile, being held together well. If And as long as that continues, the market will continue. But we're in a state where it wouldn't take a lot, in my honest opinion, to shock the markets and just have a big sell-off and liquidity issues. And some people would argue with that and say no. But the fact is that you only know until after the event, and when the yield curve's inverted, it's usually not a good sign. This green bicep is out of here. Thank you for your time and tuning in. Talk to you later. Bye.